Okay, so now we're going to talk about the various forms that a business can take. In short, a business can take one of four forms: sole proprietorship, partnership, limited liability company, and corporation. Now, there are four categories of partnership, which we'll talk about in a minute. And there are two categories of corporations, which we will talk about in a minute. But essentially, a business can take the form of either a sole proprietorship, partnership, limited liability company, or a corporation. Now, we will discuss each of those forms of business in terms of its legality, unlimited life, ease of formation, mutual agency, liability, and taxability. So let's start with the sole proprietorship. As the name implies, a sole proprietorship is a business entity that is owned by one owner and one owner only. Now, as I mentioned, it is a business entity. But the thing to know about a sole proprietorship is that the proprietorship is not a separate legal entity. It is not considered separate from the business owner, him or herself. The two are the same as far as the law is concerned. The sole proprietorship and the owner are one. Now, this has some perks, this has some downsides. The perk to there being no legal distinction between the sole proprietorship and the owner lies in taxability. The net income, or the income from the business, the sole proprietorship, is not taxed at the business level. Now, don't think that means you're not going to pay taxes. The taxes flow through to the business owner, and it is the business owner who pays taxes on that income, on those revenues that are earned by the business entity, the sole proprietorship. And as a general rule of thumb, individual income taxes are at a higher rate than corporate income taxes. So the upside, only taxed once. The income flows through to the business owner, but the business owner is probably going to pay a higher tax rate than if the business entity were incorporated. Now, the big downside to there being no legal separation between the sole proprietorship and the owner lies in the concept of unlimited liability. So let's say I have a lawn mowing, a landscaping company. It's a sole proprietorship. I am the sole owner and operator. And while I'm out working one day, I run over someone and I get sued. I run over someone with a riding lawnmower and I'm sued. The plaintiff can not only sue the sole proprietorship into bankruptcy and seize all the assets, but according to the concept of unlimited liability, the plaintiff can come after my personal assets. So my car, my house, my 401k, my vacation home, my boat, everything that I own, the plaintiff can come after, because again, as far as the sole proprietorship is concerned, there is unlimited liability. There is no legal separation between the business and the owner. That is a very, very worrisome thing. The life of a sole proprietorship is limited. When the sole proprietor dies, the sole proprietorship ceases to exist. The sole proprietorships are very easy to form. You can do it in a couple of hours. In fact, I don't even think you need to fill out or submit any documentation with the state, Secretary of State. I think it would be a good idea to do so, but I'm not sure if it's absolutely necessary. There is no mutual agency. Mutual agency is the power of another owner to enter into legally binding contracts and financial obligations. So proprietorship only has one owner, so there's no mutual agency. There's no other owner to make decisions or enter into contracts or financial obligations. We talked about unlimited liability. And again, we also talked about taxability. The sole proprietorship is not taxed. the owner, the sole proprietor, who is taxed, and the sole proprietor usually pays taxes at the individual tax rates, which tend to be higher than corporate tax rates. Now, the next form of business entity is the partnership. And as I said earlier, there are 4 flavors or 4 categories of partnership. The general partnership, the limited partnership, the limited liability partnership, and the limited liability limited partnership. Now, that 4th category of partnership, the limited liability limited partnership, isn't covered in the text, so we're not going to pay too much attention to it here. I want you to know, though, the differences between a general partnership, a limited partnership, and a limited liability partnership, particularly in terms of liability exposure of partners and mutual agency. So, just like with the sole proprietorship, all forms of partnership are in fact a business entity. Just like with a sole proprietorship, all forms of partnership, none of them are legal entities. It's a little bit easier way to say it. No form of partnership is a legal entity. So that means to say, just like with the sole proprietorship, remember when we said the sole proprietorship and the owner were one? The same is true with the partnership. There is no legal distinction or differentiation between the partnership and the partners. By the way, whereas a sole proprietorship can only have one owner, a partnership by definition must involve at least 2 owners, but you can have an infinite number of partners. The life of any form of partnership, just like with the sole proprietorship, is limited. If a partner, regardless of which form the partnership takes, a GP, LP, LLP, or LLLP, if a partner dies, the partnership has to be dissolved. Now, it can be reconstituted, it can be reformed with the remaining surviving partners, but it must first be dissolved. If you add a new partner, if there's a new partner that's coming on board, again, you have to dissolve the old partnership and reconstitute the new partnership, including the new partner. And by the way, all partnerships should include a partnership agreement, which is a legal document that lays out exactly how income and losses will be shared amongst the partners, and the admittance of new partners or the dissolution of the partnership. Partnerships aren't that difficult to form. Really, the only thing that makes them a little bit more complicated than a sole proprietorship is that you really should have a partnership agreement, which means going and seeing a lawyer and sitting down and think about various scenarios, like, how are we going to divvy up income, net income? How are we going to handle losses? How are we going to admit a new partner? What happens if a partner wants to leave? So these are all the things that you want to think about in the partnership, and put down in writing in the partnership agreement. Now, liability for a partnership depends upon the type of partnership and the partner involved, okay? This is one of the more complicated concepts of partnerships. For a general partnership, now general partnership you have to have, well, all partners are general partners. So let's say I've got my landscaping business. It's a general partnership. There are 3 partners. Each is a general partner. If partner A goes out and has an accident on a riding mower and injures someone, and the partnership gets sued, of course, the partnership's assets are up for grabs. And let's say the verdict, let's say we go to a jury trial, and the jury comes back with where we have a settlement of, like, let's say $10 million. Like, we have to come up with $10 million. And let's say there's only $1 million worth of assets in the partnership. So of course, the partnership is forced into liquidation. We sell our assets. Maybe we get $500,000 for it. But the plaintiff wants as much money as possible. So the next person they sue is the tortfeasing general partner, okay? And then when they get done with him or her, they can come after the personal assets of either two or both remaining partners. That's really, really frightening, okay? The concept is unlimited liability. Now you also have something in a general partnership called mutual agency. And that's where, and this is another very dangerous concept. In a general partnership, each and every partner has the legal authority to go out and enter into legally binding contracts and financial obligations that bind the partnership without consulting the other partners. That's extremely dangerous, and I can tell you a story about that. In fact, I might as well. Years ago, when I was a kid growing up, there was a kid on the block that I went to school with, who shall remain anonymous, but his father was a very successful lawyer, family and criminal lawyer. And this is back in the early 70s, late 60s. He had a general partnership, he had a general partner, but apparently he didn't know that the general partner had a gambling problem. And the general partner with the gambling problem went to the bank, took out a loan for like $50,000, which in 1972 was like $500,000, something like that. It was a lot of money. Took out a loan. This is back at a time when a house in our neighborhood was like $25,000, and these were fairly nice houses. So that should tell you something. So the general partner with the gambling problem took out the loan against the bank under the guise of expanding the practice, and the bank did not take into consultation the other general partner because the first partner had mutual agency. Partner with the gambling problem disappears. Bank comes looking for its first installment. The honest lawyer is flabbergasted and stunned, and he had to liquidate the partnership, sell his house, and move. Now, about 5 years later, he got everything straightened out, and the kids that I had once played with, I was back in school with again, and they were back living in the general area, so that lawyer recovered. But he was almost, his business was forced into insolvency or into receivership because of mutual agency. So be very, very, very careful when you form a general partnership. And in fact, I can't remember the last time I saw a general partnership for that reason. Like the sole proprietorship, a general partnership is not taxed at the business level. It's taxed at the individual partner's level, so all net income that the partnership derives is allocated, distributed amongst the partners per the partnership agreement, and they pay taxes. And again, they're going to pay taxes at the individual income tax rate as opposed to the corporate tax rate. Okay, so takeaway: never form a general partnership. Now, there is something called a limited partnership, and what I want you to kind of understand here is, as we move across the spectrum from general partner to limited liability partner, you're going to notice that the legal, the liability exposure and the legal responsibility for acts of, say, malfeasance or malpractice become increasingly more focused on the actual tortfeasor. For a general partnership, everybody is vulnerable. When one partner does something wrong or bad, everybody's at risk. Limited partnership dials that in a little bit. In a limited partnership, you have to have at least one general partner, and you have to have at least one limited partner. Now, the difference between the two is the general partner may have been an actual practitioner in that partnership's field. So maybe it's an accounting firm, and maybe the general partner had been an accountant at what time, but he or she doesn't do any accounting business now. His or her responsibility is running the business, so he or she is engaged in day-to-day decision making and day-to-day operations. Limited partners are the money shakers. They're the ones who bring in the money. They're the actual practitioners, okay? Or they're just partners, silent partners who've given capital to the partnership. But so let's talk about the accounting firm. You've got the general partner who is no longer practicing but is managing the company. The limited partner or limited partners are the income earners. They're the ones who generate income for the partnership. If one of them commits an act of malpractice, then yes, just like with the GP and the sole proprietorship, the first thing the tortfeasor goes after are the assets of the partnership. And then the next would be the general partner's assets, and this is why a GP and an LP is usually paid much better. Okay. So the tortfeasor will go after the LP's assets first, the partnership's assets first. Then they will go after the general partner's personal assets, and then they will go after the limited partner, the tortfeasing limited partner. The other limited partners, their personal assets are immune unless they've been involved in business activities, okay? And unless they've been involved in decision-making activities. Once in a while you can get away with it, but if you're doing it regularly, the plaintiff's attorney will probably, it's called piercing the corporate veil. And once they've pierced the corporate veil, a limited partner no longer has immunity. They're exposed to unlimited liability just as much as the tortfeasing limited partner was, and just as much as the general partner. Okay, so that brings us to the limited liability partnership. Now, in an LLP, there are no general partners. So I don't know how business decisions are made in an LLP. Okay. But the nice thing about the LLP is, and again, you find these in legal offices, accounting firms, medical offices, dental offices. If one partner commits malpractice, yes, just like the other forms of partnership we talked about, the partnership's assets are up for grabs. And certainly the tortfeasing limited partners' personal assets are up for grabs, but no one else's. Okay. I don't know anything at all really about limited liability, limited partnerships. I know that they are a separate business entity. Again, just like all the other partnerships in the sole proprietorship, they are not. It is not a separate legal entity. So all forms of partnership, LLP, LP, GP, whatever, there is no separation between the partnership itself, the business, and the owners. No separation. Okay. Ease of formation for all forms of partnership, like I said, medium. Really, the most difficult thing is the partnership agreement. Mutual agency is something I don't think I spoke about. Yeah, in the general partnership, as I mentioned, mutual agency, all GPs have mutual agency. Very, very, very dangerous. Okay. Like I said, in that landscaping scenario where you've got 3 GPs, one of them could go over to Home Depot and buy, $10,000 worth of lumber because he's building an extension to his house. And there's a pretty good chance he can get away with it unless there's something in some kind of a codicil, a restrictive codicil or a covenant in the partnership agreement specifically delineating and restricting what kind of activities a GP can be involved in. I think, he can stand a pretty good chance of getting away with it. Now, if you do have that kind of verbiage in there, I'm thinking, well, you're not a general partnership now. You're a limited partnership. So, but anyway. A limited partnership, there is mutual agency. As I said, in a limited partnership, you got to have at least one GP and at least one LP. So let's say, for the sake of argument, you got 2 GPs and an LP. You got mutual agency there. Beware. For an LLP, there are no general partners, no mutual agency. And again, I'm not really sure about an LLP. So let's talk about limited liability companies now. Limited liability companies are kind of a neat combination of corporations and everything we've talked about before. In fact, I'll tell you what, let's talk about corporations next. So there are 2 forms of corporations, the S and the C. And what differentiates or distinguishes an S Corp from a C Corp is size. I can't remember the figures, but I think an S Corp can only have like 250 shareholders and upwards of like maybe $200 million in market capitalization. I don't know, I can't remember offhand. You're not going to be tested on it. But just remember, S corporations are smaller than C corporations. And S corporations have some perks to them. Yeah, they're a business entity, just like every other form of business we've talked about up to this point. What's really neat is when you get into corporations, regardless of C or S, they are separate legal entities. Now there's a gap between the business and the owner, or as we call them, shareholders. Okay, and that's really, really big because that gap means they can't. Well, the big thing is limited liability. Remember how we said with sole proprietorships and partnerships, there's no legal distinction between the business and the owner or owners, and that the real risk there lay in the form of unlimited liability, okay, especially for a sole proprietorship or a general partnership. Now you have limited liability limitations. Your liability, a shareholder's liability, is limited only to the amount of their investment in the company. So if I owned $10,000 in common stock for Coca-Cola, and Coca-Cola turns out was doing something like pumping toxins into the river that was leaching into the groundwater and poisoning towns downstream, my liability was limited strictly to the $10,000 that I put into the company that I invested in. Now, there are occasionally, you will hear about sometimes the government will, like for example in an EPA case, the government will prove that the shareholder knew that the company was doing something, something bad, something wrong, and the shareholder will lose that immunity, but that doesn't happen very often. Okay, so you've got your corporations, you've got separation, you're limited, the shareholders' liability is limited strictly to the amount that they've paid into, they've contributed to the company. That's great. Now, the downside is double taxation. Profits are taxed at the corporate level, and then anything that's left over, it's called net income, gets paid into an account called retained earnings. And then the corporation may elect to distribute that retained earnings out to the shareholders in the form of dividend payments. And when that happens, the dividends are taxed at the individual level. So the corporation generates income, that income is taxed. Any residual net income goes into retained earnings, and if the retained earnings is paid out as dividends, the dividends is taxed at the individual level. An LLC has unlimited life. So if the owner dies, that's fine. The LLC, the S Corp or the C Corp continues to live. Ease of formation for corporations. A little difficult, okay? It's not something you're going to do. You're going to wake up on a Saturday morning and do over a cup of coffee, okay? You have to have articles of incorporation. You have to issue stock. That stuff's going to have to be notarized. You have to submit your documentation to the Secretary of State. It's not easily done, okay? It's not hard, but you're probably going to have to retain a lawyer for advice and consultation services, that kind of thing. So it's not impossible. It's not as easy as setting up a sole proprietorship. Mutual agency. This is the other benefit of that legal separation, where the law recognizes a legal difference between the corporation and the owner. Mutual agency. I, as an owner of $10,000 in Coca-Cola stock, cannot go out to Home Depot, buy a couple $1,000s worth of materials and say, hey, put it on Coca-Cola's tab. No, it doesn't work like that. The shareholders cannot enter into legally binding contracts and financial obligations on behalf of the corporation. So proprietorships can, general partners can, but not corporations. And then we talk about taxation. Now, here's the interesting thing. C corps are taxed. S corps are not, which is one of the reasons why S corps are kind of popular. The problem is they're a little more complicated to set up than an LLC. But again, they're taxed at a lower rate. But again, a C corp is limited to the number of shareholders it can have, and that's true of market capitalization. So, now, in between, if you think of sole proprietorships and partnerships as one block, and you think as corporations as another, you tend to see that there are some common pros and cons. Like I said, the common thing about sole proprietorships and partnerships, none of them are separate legal entities apart from their owners. Okay? All of them have some form of mutual agency and some form of unlimited liability. Okay? Corporations are legal liabilities. Corporations, owners of corporations do not have mutual agency. They have limited liability. Okay? An LLC is kind of the perfect amalgamation of the pros of both. Okay? A limited liability company can be owned by just a single person. It's called the managing member. Yes, it is a business entity like everything else we talked about. It is also, like a corporation, a separate legal entity. So what does that give us? That gives us separation. That gives us limited liability and no mutual agency. Here's the other thing, though. The other perk. It's not taxed. The LLC is not taxed. But once again, any net income flows down to the owner and is taxed at the individual level. Ease of formation, actually pretty easy. I set up an LLC in the course of the morning, just a few months ago. So those are the various forms of business entity: sole proprietorship, partnerships, and corporations. And that's pretty much it.